AYPO Real Estate Finance newest actual exam. Question 1. What does the acronym for the Special Purpose Investment Vehicle REMIC stand for? Real Estate Market Insurance Corporation, Real Estate Mortgage Investment Conduit, Regional Equity Mortgage Investment Company, Residential Emergency Mortgage Interest Credit. A real estate mortgage investment conduit, REMIC, is a complex pool of mortgage loans that are bundled into a single investment vehicle. For tax purposes, it is a pass-through entity, meaning it doesn't pay taxes at the corporate level. Instead, income is passed through to investors and taxed at their individual rates. They were established by the Tax Reform Act of 1986. Question 2. What was the primary reason for the formation of the Federal Home Loan Mortgage Corporation, Freddie Mac? To provide high-interest loans to high-risk buyers. To replace the Department of Housing and Urban Development. To provide competition for Fannie Mae and expand the secondary market. To regulate the interest rates set by the Federal Reserve. Freddie Mac was created in 1970 to provide a secondary market for mortgages originated by savings and loan associations. Its primary goal was to provide competition to the Federal National Mortgage Association, Fannie Mae, thereby increasing liquidity and stability in the U.S. housing market. Question 3. Currently, what is the primary activity of the Federal National Mortgage Association, Fannie Mae? Lending money directly to first-time homebuyers, purchasing conforming loans from primary lenders and bundling them, setting the national APR for all residential loans, foreclosing on properties in the primary market. Fannie Mae operates exclusively in the secondary mortgage market. It provides liquidity to the primary market by purchasing conforming loans, loans that meet specific guidelines, from banks and other originators. These loans are then bundled into mortgage-backed securities, MBS, and sold to investors worldwide. Question 4. In the financial markets, where do initial public offerings, IPOs, and mortgage-backed securities, MBS, sales generally occur? IPO, secondary market, MBS, primary market. IPO, primary market, MBS, secondary market. Both occur exclusively in the primary market. Both occur exclusively in the secondary market. An IPO, initial public offering, takes place in the primary market because it is the first time a company issues stock directly to the public. Conversely, mortgage-backed securities, MBS, are typically traded in the secondary market, where existing financial instruments, loans already originated, are bought and sold among investors. Question 5. Which historic U.S. event served as the catalyst for the formation of the FHA and other organizations supporting the mortgage market? World War II, the American Civil War, the Great Depression, the Industrial Revolution. Prior to the Great Depression, mortgages were typically short-term, high-interest loans that required frequent refinancing. When the market crashed, millions lost their homes. The government created the FHA in 1934 to provide mortgage insurance, allowing for long-term, fully amortized loans that made homeownership safer and more accessible. Question 6. How do insurance companies typically interact with the residential housing market? They sell homeowner policies but do not lend capital. They build large-scale residential subdivisions. They lend out their capital for mortgages through other outlets/intermediaries. They are prohibited by law from investing in mortgage-backed securities. Insurance companies possess vast amounts of capital from policy premiums. To generate a return, they invest heavily in the mortgage market. While they rarely deal directly with homebuyers, they provide significant funding to the secondary market or lend through mortgage bankers to facilitate residential and commercial loans. Question 7. Which of the following is generally not true regarding the operations of a standard commercial bank? They issue a variety of loan types. Their primary focus is on underwriting and the securities trade. They often engage in non-banking activities like insurance. They are regulated by the FDIC. Commercial banks traditionally focus on deposit-taking and providing various loans, consumer, commercial, and mortgage. While some large banks have investment arms, Their primary focus is not typically the high-risk securities trade, that is the domain of investment banks. Commercial banks prioritize liquidity and risk management for their depositors. Question 8. Approximately what percentage of typical pension fund holdings are comprised of mortgages and mortgage-backed securities? 3%, 25%, 50%, 75%. Pension funds are traditionally conservative. While they are a massive pool of capital, mortgages and mortgage-backed securities, MBS, currently make up a relatively small portion, approximately 3%, of their total holdings. They prioritize long-term stability and diversification across stocks, bonds, and other assets. Question 9. Life insurance companies currently show a lending preference toward which type of real estate loans? Single-family residential fix and flip loans, unsecured personal loans for landscaping, commercial mortgage loans, short-term construction loans for tiny homes. Life insurance companies prefer long-term, large-scale investments that provide steady returns to match their long-term policy obligations. As a result, they lean heavily toward commercial mortgage loans, shopping centers, office buildings, warehouses, rather than individual residential mortgages. Question 10. Which of the following best describes the difference between a mortgage broker and a mortgage banker? Bankers work with multiple lenders, brokers work for one bank. Brokers work with multiple lenders for a commission. Bankers are salaried employees of a single lender. Bankers cannot issue loans, brokers only issue government loans. There is no legal or professional difference between the two. A mortgage broker acts as an intermediary who shops a borrower's application to various lenders to find the best rate, only getting paid if the loan closes. A mortgage banker works for a specific institution, the bank that uses its own funds to originate and fund the loan. They are typically salaried employees of that specific institution. Question 11. Which of the following is a common characteristic of savings and loan (SNL) associations? They are owned and managed by the federal government. They are locally owned and privately managed. They are prohibited from issuing residential mortgages. They only deal with international corporate finance. SNL associations, also known as thrifts, were traditionally established as community-based institutions. They are typically locally owned and privately managed, with a historical legal mandate to focus on residential mortgages and encouraging local savings among community members. Question 12. Regarding the documents used in a real estate loan, which of the following statements is false? The mortgage is the security for the debt. The promissory note is the evidence of the debt. The promissory note is recorded with the county land records. The security instrument, deed of trust, is recorded. While the mortgage or deed of trust, the security instrument, is recorded in public records to create a lien against the property, the promissory note is a private contract between the lender and borrower. The note is the IOU and evidence of the debt. Recording it is not required and would expose the borrower's private financial terms to the public. Question 13. Which of the following is not recognized as a legal type of easement? Easement by necessity, easement in gross, easement in trust, easement by prescription. Standard legal easements include appurtenant, attached to land, in gross, attached to a person/entity, necessity, for landlocked parcels, and prescription, long-term hostile use. Easement in trust is not a standard legal classification of a land use right. Question 14. To what does an easement appurtenant specifically attach? A specific individual or corporation, the current owner's credit score, a specific piece of land, the dominant tenement, the county's general tax fund. An easement appurtenant runs with the land. It is not a personal right, instead, it is a permanent right that benefits one parcel of land, the dominant tenement, by allowing use of an adjacent parcel, the servient tenement. When the property is sold, the easement automatically transfers to the new owner. Question 15. What is the primary difference between a mortgage and a deed of trust? A mortgage has 3 parties, a deed of trust has 2. A mortgage is only for land, a deed of trust is for buildings. A mortgage involves two parties, borrower/lender. A deed of trust includes a third-party trustee. Only a mortgage allows for a non-judicial foreclosure. A mortgage is a two-party instrument between the mortgagor, borrower, and mortgagee, lender. A deed of trust is a three-party instrument. The trustor, borrower, conveys naked or conveyable title to a neutral third-party trustee, who holds it for the beneficiary, lender. This structure allows the trustee to conduct a power of sale non-judicial foreclosure if the borrower defaults. Question 16. Texas is classified as which type of state regarding real estate transactions in title? Title theory state, intermediary theory state, lien theory state, absolute ownership state. In a lien theory state like Texas, the borrower, mortgagor, retains both legal and equitable title to the property. The lender, mortgagee, simply holds a lien or a legal claim against the property as security for the debt. If the borrower defaults, the lender must go through a legal process to foreclose on that lien to satisfy the debt. Question 17. What distinguishes a conforming loan in the secondary market? It is a loan for an abnormally large jumbo amount. It is a loan that conforms to Fannie Mae and Freddie Mac guidelines. It is a loan that does not require a promissory note. It is a loan only available to veterans. Conforming loans are mortgages that meet the specific criteria, loan limits, credit scores, debt-to-income ratios, established by Fannie Mae and Freddie Mac. Because these loans conform to standard risks, they are easily packaged into securities and sold on the secondary market. Question 18. Savings and loan banks were originally created with a specific focus on funding international trade wars, industrial manufacturing equipment, promoting home ownership and local savings, underwriting initial public offerings. The historical mission of SNLS, thrifts, was to provide a safe place for local citizens to save their money and to use those deposits to provide long-term mortgages for community members to buy homes. This virtuous cycle was the backbone of American community development for decades.